I need you to sit down and listen, because I am about to tell you something that will either save your financial life or cost you everything. And I mean that literally, not as hyperbole, not as clickbait, literally. This is the biggest warning I will ever give about gold and silver. And I need you to hear it clearly, because the window to act on it is closing faster than most people understand. I have spent 40 years in rooms where real money moves. I have watched 3 major financial crises unfold from the inside. I have seen what happens when confidence breaks. I have seen what happens when the system that everyone believed was permanent reveals itself to be fragile. And I am telling you with absolute certainty that we are approaching a moment that will dwarf everything that came before. The warning is not about gold. Gold is the senior monetary metal. Central banks understand gold. Governments understand gold. The wealthy understand gold. If you own gold, it's not our job. You own something that governments have fought over since before paper was invented. That is not my warning. My warning is about what happens to silver and to the people who own it and to the people who do not own it when they suddenly decide they need it. By the end of this video, you will understand the exact sequence that is about to unfold. You will understand why this moment is different from every other moment in modern monetary history. You will understand the 3 converging forces that have never converged simultaneously before. You will understand the 4 stages of what happens next. And you will understand exactly what separates the people who will be grateful they listened from the people who will spend the rest of their lives saying, I knew I should have done something. So let me start with the thing that terrifies me most. It is not the debt. Yes, the United States carries $39 trillion in debt. Yes, annual interest is $1.3 trillion. Yes, $9 trillion needs to be refinanced in 2 years at rates 4 times higher than they were. Yes, the arithmetic is impossible. But I have known the arithmetic was impossible for 5 years. So have other people in this room. What terrifies me is that the public finally understands it too. Write this down. When a problem is known only to experts, it can be managed quietly. When a problem becomes known to the public, it becomes viral. And a viral loss of confidence in paper money moves at a speed that no policy can contain. I watched the Russian central bank get blindsided in February 2020 or 22. I watched their reserves get frozen with a keystroke. $300 billion gone, not seized through war, not confiscated through default, frozen by policy, and every finance minister on the planet got the message at the same moment. If it can happen to Russia, it can happen to anyone. That is the first converging force. The weaponization of the dollar. The moment trust in the reserve system broke, the response has been the most sustained central bank accumulation of hard assets in modern history. China buying every month, Russia for over a decade, Poland, Hungary, India, Turkey, Singapore. The institutions that print paper currency are buying the asset paper currency was supposed to replace. That is not a coincidence. That is a surrender. That is the elite admitting something they can never say out loud. The second converging force is debt. But not just debt. The collapse of any credible path to dealing with debt honestly. The Federal Reserve cannot do what Volcker did. Volcker took rates to 20% in 1980 because the debt load was manageable. Try 20% rates on $39 trillion of debt. The arithmetic is not just bad, it is suicidal. So the only exit, the only path that doesn't end in either default or depression is to inflate the debt away. And inflation requires currency debasement, and debasement requires that people believe the currency is worth holding during the debasement. And that belief is fragile. The dollar has lost over 90% of its purchasing power since the Federal Reserve was created in 1913. Most people say that like it's history. It's not history. It's prophecy. It's telling you what happens to paper money when the institutions that issue it become trapped between impossible choices. The third converging force is silver specifically. And this is where the picture becomes almost unthinkable. Silver is not just a monetary metal. It is the industrial metal that the modern economy cannot live without. Solar panels, electric vehicles, semiconductors, defense systems, AI data centers, 5G, medical devices, Every technology that politicians say they want to build requires silver. And most of that silver is consumed in ways that are not economically recoverable. It is used and gone. Mine supply is flat for a decade. 70% comes as a byproduct from copper mining. That means silver supply cannot flex. And demand is not slowing down. Solar consumed over 200 million ounces last year. Projections show 400 million ounces annually by 2030. That is half of current mine supply from one industry. So you have a metal that is simultaneously a monetary safe haven and a critical industrial input. You have supply that cannot respond. You have demand that is structural. And you have a physical market sitting beneath a paper market that has become dangerously leveraged against actual metal. This is not opinion. This is mechanical. Now, I need you to understand what happens when those three forces converge. It does not happen gradually. It happens in stages. And each stage surprises people who are not paying attention. Stage one is the paper flush. A shock hits. The dollar strengthens temporarily, yields rise, funds de-lever. Silver gets sold because it's liquid. The screen shows weakness. People conclude the thesis is broken. But this is just positioning. This is margin calls. This is not physical reality. Stage two is the premium split. While paper silver is being sold, physical silver tightens. Dealers start limiting size. Delivery windows stretch. Premiums widen. 10%, 20%, 30%. And you realize that the screen price and the real world price have become two different things. The quote says silver is cheap. The shelf says silver is unavailable. Stage three is the industrial squeeze. This is where it gets dangerous. Manufacturers start to compete with investors. They need silver to keep factories running. They are not speculators. They do not care about your opinion of the market. They will pay what they have to pay. And once industry is bidding, premiums accelerate. Delivery times extend further. Registered stocks on exchanges begin to decline. Backwardation appears. That is stress. That is the market telling you that immediate physical silver has become more valuable than promises of future silver. Stage four is re-rating. The paper price is forced to catch up with physical reality, not gradually, violently. The old price is no longer the clearing price. A new price must be established at a level high enough that some holders will finally sell. And that price is often much higher than people anticipated. This is what happened to gold in 1979 and 1980. This is what happened to silver from 1979 to 1980. This is what happened to oil in 1973. This is what happened to every commodity that faced a real structural shortage combined with a loss of confidence in paper. The paper price suppresses the metal until the suppression itself creates the shortage. And then the market re-rates to a new equilibrium. I want to tell you about a specific moment because moments teach what data cannot. August 15th, 1971, a Sunday night. The President of the United States goes on television and ends the convertibility of dollars into gold. He did not announce that the old world had ended. He presented it as a technical measure. But it was the end. The gold price had been fixed at $35 an ounce. That was not a market price. That was a maintained fiction. By January 1980, 9 years later, gold reached $850, a 24-fold increase. Silver went from under $3 in the early 1970s to nearly $50 in 1980. People who understood that Sunday night understood that the old monetary world was dead. People who waited for the headlines to confirm it bought the top. Now fast forward to 1979. Two brothers, Nelson Bunker Hunt and William Herbert Hunt, accumulated between 100 and 200 million ounces of physical silver. They did not announce it. They did not publish research. They simply bought metal and removed it from circulation. And the price moved from around $6 to nearly $50 in 14 months. Eightfold from two private actors. Not a nation, not a central bank, two brothers. Now multiply that lesson by 1,000. Imagine not two brothers, but global pension funds managing $50 trillion, deciding that 2% needs to go into hard assets. That is $1 trillion looking for a door that is $60 to $75 billion wide. The math is not complicated. The door breaks. The price gaps. And the people who waited for permission from television never get in. This is the warning. This is what I need you to understand. The people who own silver when Confidence breaks will own silver when it re-rates. The people who own silver, when the industry begins to compete for supply, will own it when the price reflects that competition. It's not our job. The people who accumulate while the screen is showing weakness, while premiums are still tolerable, while delivery times are still measured in days, will own it when the screen finally wakes up and all the newcomers cannot find any. There is a phrase, I want to burn into your mind. You cannot unsee this. Once you understand the mechanism, once you see the three forces converging, once you understand that silver is not just money and not just industrial, but both simultaneously, you cannot look at the world the same way again. The biggest mistake I watch people make is confusing a quote with a supply chain. They see a price on a screen and think that is the market. It is not. The market is whether you can actually get the metal. In normal times, those two things are close enough. In stress times, they are light years apart. In March 2020, silver quoted near $12. Try buying physical silver at $12 that week. You could not. Dealer shelves were stripped. Delivery times extended. Premiums exploded. The screen told one story. Reality told another. That was a temporary shock. What is coming is structural. It is not a one-week panic. It is a loss of confidence in paper that takes months or years to fully play out. And during that entire period, the people who own physical metal will be insulated. The people who own claims on metal, promises to deliver metal, derivatives that bet on metal, will learn that metal is not the same as access to metal. Write this down. In a real shortage, the last people to realize it are the ones looking at a screen. Now let me be direct about what you should do. I am not here to tell you to buy or sell. That is not my role. My role is to show you the mechanism and let you choose. But I will tell you what mechanism means. Mechanism means this is not opinion. This is not prediction. This is structure. It is the same structure that has repeated after every major geopolitical shock since 1973. Shock. Oil spike. Inflation expectations. Rate cut hopes die. Bond yields elevated. Gold suppressed. Then 6 to 24 months later, confidence breaks. Money flees. Metals re-rate. Every single time. And the people who position themselves before the re-rating, the people who understood that the suppression was the opportunity, they became generationally wealthy, not because they were lucky, because they understood the mechanism. There are two types of people watching this video right now. The first type hears this warning and feels fear. That fear manifests as a desire to ignore it. They think this seems too complicated, this seems too dire, I will wait for clearer signs, and they will wait. They will watch. And 6 months from now, when premiums have doubled and delivery times have tripled, they will finally act, and they will be the crowd. They will be the people fighting for scraps at a much higher price. The second type hears this warning and feels clarity. It's not our job. They understand that the warnings that matter are the ones that sound wrong while you are listening. They understand that by the time a warning sounds obvious, the door has already closed. They understand that the biggest wealth transfers in history go to people who acted when others were paralyzed by uncertainty. I have watched both groups for 40 years. The first group always looks reasonable at the moment of truth. They talk about risk management. They talk about wanting confirmation. They talk about not wanting to be early. And they are absolutely right. They are not early. They are late. They are the crowd. The second group looks crazy for months. They look early for months. And then they look brilliant for years. So here is what I want you to understand. The warning I am giving you is not about whether gold and silver will go up. I believe they will. That is not the warning. The warning is about what happens when too many people realize it at the same time and discover that availability and price are not the same thing. The warning is that the people who position themselves before that realization will have options. The people who wait until after the realization will have desperation. The window is not open forever. Every month that passes with central banks buying hard assets, with debt growing larger, with industrial demand running steady, with supply running flat, the pressure builds more. It does not announce itself politely. It announces itself suddenly. And once it announces itself, The people who prepared are grateful they listened. The people who dismissed this are looking for a way to buy at any price. And there is no such thing. If this is the kind of warning you come to WealthWired for, the kind that explains the mechanism while everyone else is still debating the price, then make sure you are here when the mechanism confirms itself, because that confirmation will not be gradual. It will be sudden. And I want you in the room before the door closes for good. This is not my opinion. This is what the structure is telling me. And once you see the structure, you cannot unsee this.